Hello, everybody. This is Noah and John, and we are from UrbanDigs, and this is Talking Manhattan. And Johnny, we got a good one for you guys today.
We do. We're joined by yet another one of these, top 1% producers in the country, Seth Levin, the powerhouse from Keller Williams, is here to join us. So I'm expecting some fireworks today, Noah.
Yeah, me too. Seth, thank you for joining us here, and I'm going to get right into it. I don't want to waste anybody's time. It is challenging out there. It is tricky out there. It is exhausting out there. But in your words, what do you see happening in the broad market today?
I mean, this is the most schizophrenic market that I've seen in over 20 years in the business. There's clear winners, there's clear losers. Interest rates are obviously the major force that's impacting behavior in the market. Would-be buyers are sidelined. Cash buyers are, sort of most of what we're seeing in the market. And, high interest rates are not just keeping buyers sidelined. Obviously, it's keeping inventory stuck. And typically when we see low inventory environments, we see a squeeze on that inventory. We'll see price appreciation. However, obviously, we're also seeing some lower demand. And there's a lot of economic uncertainty, conflicting data points that are sort of keeping people a little bit bewildered. And, obviously, inflation is another thing that's impacting the market. And again, typically, inflation would lead people to make a hedge against inflation, buy real estate. But again, there's so much conflicting information. Our typical finance, buyers that are driving at least my portion of the market, a lot of them are on the sidelines, whether it's, uncertainty in their own careers or uncertainty what's around the corner. So, it's just a lot of uncertainty. And I think that really has bled into our market.
Yeah, that's an excellent point. And if I just want to follow that up, because you mentioned a lot of things there. And one of the things that Noah and I are constantly talking about is that this market revolves around the bids. It's really all about the bids. It's all about the buyers. And right now, with liquidity sort of declining, it's ticked up a little bit in the last couple days, but it's still at a very low point. And we actually put out a piece just today or yesterday talking about this is actually one of the most challenging September's going back to like 2008. It's a really tricky market. So with that in mind, Seth, with your buyers out there, what are the buyers today? What's on their minds? How are they thinking about this market if they're interacting today?
Well, it's interesting. We actually saw a spike in buyer activity in July and August when there was some, good tailwind. Inflation seemed to be getting in check. So, that was one of the busiest summers I've ever seen. And I'm actually, seeing the early September markets a little bit slower than I would typically expect. But the people that are in the market, I've been talking a lot about this recently. There's a lot of baby boomer money. There's a lot of older Gen X money. There's not a lot of, people striving to get into the market. So what we're seeing is empty nesters returning to the city. We're seeing them, target second homes. We're also seeing them help their young professionals make their first purchases. So it's a sophisticated group of buyers. They know what they want. What they want is quality. They're looking for value, but above all, they're looking for quality more so than I've ever seen before. It's, truly a story of winners and losers when it comes to inventory in this market. And that's, a delineation that I think is, stronger and more impactful on our market than, again, I've ever seen before. But, it's a different story in Brooklyn. We put something on the market. We expect it to go above ask. We're, coaching our buyers to look at value as opposed to asking price. So again, it's just the most segmented market that I've ever seen. And it's a skills market, for real estate agents really have to dig deep into the data and have really, deep conversations with our clients.
Yeah. It's a bipolar or some type of psychological phenomenon going on in this market right now. You mentioned schizophrenic. I'm sure we can come up with a couple more terms. Tricky, and it seems like buyers are rewarding very few and penalizing many more. May I ask you, Seth, in your opinion, what inventory or sectors are actually doing okay, and what inventory sectors are not?
Yeah. So again, I have these conversations with my team, with my clients. I speak at conferences and events around the country. And what I've been talking about more than ever is that we're in a quality climate. There's truly a shift to quality. New York City is a hodgepodge of inventory that's been built over the last, call it 150 years. And pre-war buildings, newer construction is being rewarded. I think we're actually seeing some price appreciation in some of those, better quality parts of the inventory. And the sort of middling inventory, the tenements or the 1970s, 80s buildings with the 8-foot ceilings, I just don't see them being rewarded. As Noah said, they're being punished. So also location, if you're by an exit ramp for a tunnel or a bridge, that's a really tough piece of inventory to sell right now. But, Park Avenue, the West Village, Park Slope and Williamsburg, which are, really starved for inventory, they are doing really well. There's not just one market happening right now. There's a lot of micro markets that are occurring at the same time. And that's, that's confusing as well, because we'll get a low offer on something that I know is going to get multiple bids, but that buyer is being advised potentially incorrectly, or they're, looking at, the market as a monolithic, thing that it's really not. More than ever, it is about market segments within market segments. It used to be sort of a rising tide lifted all ships. So the 1-bedroom condo market in Chelsea could be looked at, sort of price per square foot for that entire part of, the inventory. However, it's a newer building versus a 1980s building versus a building that's financially sound versus one that's not financially sound. So, again, this is a market where we've got to dig deep. You guys give some incredible tools to do that. Very thankful for UrbanDigs every single day. Agents just have to look beyond just the neighborhood, the property type, because, the buyers are walking into one apartment and they have no interest. When everybody was working in office 5 days a week, people didn't want to commute. The inventory had a lot of pressure on it. There's not a lot of pressure on the inventory right now. So there's also not an urgency to buy it, right?
That I just want to point out 2 things there, because this is what makes it so mysterious. I mean, kind of why I love these markets, but it's not an inventory thing that's driving this, because inventory is not high. I mean, you got your sellers that need to sell and want to sell, and you got some panic people there. You got a lot of growing concern and exhaustion there, but it's not like you have this mass panic flow for the exit. So from the buy side, when we say you got leverage and there's opportunities, they don't have a lot of options. That's number one. And number two, you mentioned what the buyers are bidding for, and they're bidding for these more expensive, larger quality, turnkey, don't need any intervention products. And if you think about that for a second, when those properties close and we analyze median sales price and price per square foot trends, whether it's quarter to quarter, month to month, that's going to be a higher subset of data relative because of the nature of this down cycle. And it's not going to show the discounts that's actually happening in the market right now. And that's making a very disparate, confusing market to understand.
Exactly. I look at price per square foot in a lot of market segments, and it looks to be relatively flat, but we're getting incredible discount for some of our buyers in certain segments. And we're seeing buyers bid above ask on multiple properties of ours. And I just had a best and final last night. We had multiple participants. I had a townhouse.
Brooklyn or Manhattan?
This was in Brooklyn. Brooklyn is an enigma, and I invested in Brooklyn last year because I just saw the trend and, thinking that there's a lot of appreciation because of the gap in value between, or, historic price between Brooklyn and Manhattan. And I think that gap is going to shrink. So even with the competition in Brooklyn, I still think that it's relatively undervalued. So I do anticipate that price appreciation. We're going to see, just a lot of that in the next few years.
Right. And Seth, I just want to dive into one of the things you just talked about, because I think this is probably one of the trickier things today, and that is that idea of negotiation. And we talked about how challenging this market is for sellers. And I wonder if you could touch on negotiation and what you're seeing out there right now from the buy side and from the sell side. What are sellers willing to concede? How far are buyers willing to go to close the gap?
So again, not to belabor it, but it's such a segmented market that we're negotiating so differently on one property in one neighborhood versus another property, potentially in the same neighborhood. But it's always important to understand motivation. I've been teaching a negotiation class for the last 10 years, and I define negotiation as tapping into somebody's motivation in order to, understand what you can accomplish and how you can further the goals of your clients. You're always trying to understand what somebody's position is. And there's a lot of, if there are sellers in the market right now, a lot of them are death, divorce, they're squeezing out of an apartment. If they don't have a super prime piece of real estate, we see a lot of leverage there. However, if, it's in a more competitive segment, then I'm having a conversation with a buyer, asking price is just a piece of marketing. And we're really, regardless of if it's a good piece of inventory or a bad piece of inventory, we're kind of ignoring the asking price and looking at the value. And, I was having this conversation the other day because I have been trying to shift my business more and more to Brooklyn, where I was maybe 80%, 20%. I'm trying to get to more of a 50-50 business between Brooklyn and Manhattan. And, we've won several bidding situations in Brooklyn by talking about potentially trading some future equity. We go into a situation like that and we're establishing the value. Let's say the property is asking 125. We establish the values 125. You're going to be there for 20 years because we understand the motivation and goals of our clients. Where do we see the appreciation over the next 20 years, and how much of that appreciation are you willing to trade to potentially get this property today? So even with a value of 125, I had a buyer recently go up to 138, willing to trade, $55,000 worth of future equity to get the property today. When we're on the sell side in a situation like that, we're just trying to create low pressure, get more people involved. But when it's, a weaker piece of inventory, we're really trying to understand, does this person need to sell? We're trying to, be investigators and understand the backstory a little bit so that, we can push as much as we can push. But even in the worst of markets, which this is not, I've, seen much worse markets. Obviously, I've seen much better markets. But, there's also a cap to how much you can push. So the biggest piece of negotiation is setting the expectations and establishing value with your client before going into the potential negotiation.
Awesome. Seth, you mentioned a little while ago that you stayed in Brooklyn a year ago. I love that idea. You started, it took a little while. It took a little while to yield some fruit. You mentioned seed. That's what I'm thinking. So it wasn't a instant gratification thing, which brings me to this question. You're navigating this down market wonderfully in terms of your business. And I'm sure a lot of agents are going to want to hear some tips to success. So is there anything that you can share? I know you said stayed in Brooklyn a year ago, on what has helped you kind of weather the storm and put your business in a better position to navigate through it.
I mean, it's a tricky market. There's no sort of getting around that. I had 5 buyers back out of listings of mine in the same week in July. So we are skating on a razor's edge, even when we're being successful. So, to the point about Brooklyn, I think a diversity of geography is really important in a market like this. If you're just an Upper East Side focused agent, there's a lot of inventory in the Upper East Side right now. That's going to be a tough hill to climb. But we're focusing on good inventory, saleable inventory. We're having, human to human, real conversations about what's happening in real time in the market. And, we're taking inventory that's priced appropriately for the market segment. We're setting ourselves up for success in that way. Also, I've been saying this for years. I'm an idea presenter, not an order taker. So in markets like this, where there's so many disparate markets, where there's strength and weakness across the board, and it's not just, one market, being an idea presenter is talking to somebody and saying, you've had this property for a while. I know you're growing out of it. I know you're hearing that it's a tough market, but you're actually in a seller's market, and what you're looking to get into is a buyer's market. And particularly if someone's like, doesn't need financing on the back end, we could advise them that there's relative weakness in this market. The trade up market potential for arbitrage is there. And, it's something that we're really focusing on in this market. We're also having conversations about interest rates, obviously. And similar to when I was talking about trading a little bit future equity in a bidding situation, we're also saying, interest rates, we're not going to see the 2.75s again. But when interest rates come down, there will be more participants in the market. So are you willing to pay, extra $1,000 a month in a mortgage for the next 12 months in order to see, appreciation, potentially $100,000 worth of appreciation when interest rates come down to a level that brings people back into the market? So it's high level conversations, it's seeking arbitrage. And, I was actually telling Noah this story recently that, this is an UrbanDigs success story. That's something that has been invaluable to me. I love the market pulse. I love how easy it is to identify relative strength and relative weakness in the same market in the city. So in 2019, this is one of my favorite stories. I tell it at every negotiation training that I've given since this time, just to show people that there's never just one market and arbitrage is always available. I had a client, Liz, that I put into a 1-bedroom in Chelsea in 2007. And I bumped into her and her recently married, husband in 2019. And they said, we're about to start trying to have a kid. And I said, oh, that 1-bedroom is going to get really tight. And she was like, yeah, but the market is so bad. I think we're just going to hold off. And I knew that the 1-bedroom co-op market was really strong at that time. So I set up an appointment to meet with her. I showed her that the market pulse, I remember these numbers because I speak to them so often. The market pulse for Chelsea 1-bedroom at the time was 1.2. They wanted to be in a 3-bedroom condo. At the time, the market pulse for a 3-bedroom condo was 0.15, 1.2 versus 0.15. Hyper aggressive sellers market, really weak, buyers market happening at the same time. She decided to test the market. We put her place on the market in Chelsea for 1.2 million. That was the highest price that would have ever been established in that building. We achieved it within a week. She then wound up buying a 3-bedroom condo, newer construction, that was originally asking 3.9, was dropped to 3.2. We got it for 2.75. That apartment today is worth about 3.6. So again, it's really understanding the market dynamics, being a idea presenter as opposed to an order taker, and we can help people achieve success, wealth, comfortability in a real estate market that other people are just sitting on the sidelines. And I think that that's what's helping me in this market is just, being creative, digging deep into the data.
I mean, first of all, it's a fantastic story. I mean, you're hired.
Yeah.
It's great. But I want to follow up because I really like the idea that you're an idea presenter and you're not an order taker. And I want to bring it back to almost the fine point of it, which, I get that that's really helpful for high level conversations. But you also mentioned that you had a week in which you had buyer after buyer drop out of negotiations for whatever reason. And I'm curious how the idea of being an idea presenter affects your mindset to kind of, bridge that gap between, all right now is really difficult. However, I know that because I'm presenting these ideas, I know that because I'm sort of, an advisor, that business will come back to me versus, oh my God, what am I going to do now? Everything fell apart.
Exactly. Well, I think 2 decades in this industry has helped me develop some pretty thick skin, and we're always looking forward. We're not dwelling. This is a tough market. Deals are taking longer, which makes, buyers that are already hesitant, they're already skating on a razor's edge. They're already, ready to back out. So another thing that I think is super important in this market is getting ahead of the negatives. And, every building, there's something. So be the person that discovers that before the buyer. Deal with it prior to the due diligence. Deal with it prior to the potential, dismantling of the deal. And, if it's an upcoming assessment, talk to the seller about paying the assessment. Those 5 deals, they were actually all my listings. We have 4 of them either in contract or closed, and only 1 of them has not come back. And that one, we got ahead of it. It needed some work. So we took it off the market. We did a little bit of work and we're seeing traction now. So it's getting ahead of the negatives. And, this is a belly to belly business. The more conversations you have, the more business you're going to have. We understand that in a market like this, you're going to have some losses, but the goal is to have more wins than losses.
Yeah. It's September 27th when we're recording this. I don't know when we're going to put it out there. And as I stand here now looking at all the data and talking to a lot of people, I can't think of a better time for buyers to pull the trigger right now. And if it's interest rates that is holding them back, and that is the main concern, there's so many creative ways that we can come up with to make it. Talk to 5-10 lenders and see what the best products are between those guys. Talk to your seller and see if they can pay down points in some capacity, like developers are doing, and talk to your attorney to see how those deals can get structured. It's not worth it to lose a deal over something that could be fixed in today's market. And, you may get a lower rate in the future, but you may not get the combination of fear, leverage, exhaustion that's going on right now. And it's not showing up in a lot of the data set. You got to look. You got to look, and you confirmed it. It's a tale of 2 markets. Nobody said it was easy. If it was easy, everyone would do it, right? That's how Jimmy Dugan would have liked that line. But I thought this was fantastic. John, do you have any other questions for Seth? Otherwise, we're going to wrap.
I got one more question, which is, Seth, you do have a nice long track record in the industry, and I'm curious, looking back, what would you have liked to know on day 1 of your career that you know now?
Ooh. There's so many. I would have loved to have seen more transactions quickly. But my biggest takeaway from being in this industry for so long, especially for newer agents, is not to work by price point, work by relationships. Business begets business. And I have an anecdote of a $400,000 buyer who led to $50 million worth of referral business in a 6-year period. So don't close doors before they're open. Have human to human conversations with people, understand their motivation, understand their goals, speak to their concerns, don't dismiss them. And, again, just understand the market. But as you guys always talk to, you have to understand the finance and economic trends and storylines that are impacting our market so that we can understand where we're going. I don't know if I necessarily answered exactly what I would have.
That was awesome.
That was awesome.
That was absolutely awesome. And never underestimate what one little client could roll into. You never know who somebody knows. And sometimes I have a theory that sometimes they like to test. They're like, all right, we'll buy something small with this guy, see if he's the right guy, and then we'll go pull out the big dogs and send in all the referrals or buy some bigger places. I've seen it before. And another quick anecdote before we end this. I remember I was at City Habitats and one of the agents got a $3,000 rental or $2,000 rental. They didn't want to deal with it. At the end of the day, it turned into a $6 million purchase. A $6 million purchase. And it was like a headache client. And they're like, you know what? Let's just buy this huge place. And they had no idea at first that this family was in that position. And it turned out that was the case. So you never know. I thought this was great. Seth Levin of the LevinKong Team over at Keller Williams. If you got any nuggets of wisdom, send him a thank you. Talk to him about referrals. If you see any of his listings, do some business with this guy. He's a great guy. And thank you so much for sharing your thoughts. That is John Walkup. I am Noah Rosenblatt. We're both from UrbanDigs. This has been Talking Manhattan, and we will catch you next time.